Hi everyone, this is Jerry Chan from RealEstateTaxTips.ca, your real estate accountant here. Today I'm going to share with you with my not so great voice. I still have not recovered from my cold that I got from last week, so I'm still having a problem speaking. So one of the questions that I often get from investors, real estate investors, and sometimes real estate agents as well, is to whether to claim capital cost allowance against their rental building to offset their rental income. So it is a great question. Before we dive into, hey, like whether we should claim capital cost allowance or not, I think it is important to get a better understanding of what capital cost allowance is. And tomorrow I'm going to talk about whether you should claim capital cost allowance or not. What is capital cost allowance? Capital cost allowance is a wear and tear. It's a tax term that is defined by CLA, Income Tax Act. You can claim capital cost allowance. Essentially, the wear and tear is equivalent to depreciation or the wear and tear on the building. You're allowed to claim the wear and tear on the rental property that you own against your rental income. Um, what does that really mean? What it means is that when you purchase a property, for example, for $400,000, you will be able to claim a portion of that $400,000 on an annual basis to offset against your rental income you received, net rental income you received, and but based on the rates that CRA provides. Currently, the building amortization rate, this capital cost allowance rate, is 4% on the building. So it would be the first year, it will be 4% multiplied by the purchase price, which is $400,000, and then multiplied by the first year's half year rule. Now, how does this concept work? Capital cost allowance is similar to something called RSP. We are all familiar with RSP. The year that you make the RSP contribution, you don't have to pay the tax. Same in capital cost allowance. The year that you take the capital cost allowance deduction, you do not need to pay the tax on the net rental income. But similar to RSP, when you withdraw the RSP, you have to add that RSP withdrawal to your income. In the capital cost allowance way, you have to claim all the capital cost allowance that you claimed. You have to add these capital cost allowance that you claim throughout the years, because every year you can claim a portion of it. Maybe first year you claim 5,000, second year you claim 2,000, then the third year you claim 3,000, and year four you sell the property. So over the 4-year period, you've claimed about $10,000 of capital cost allowance, and these $10,000 when you sell the property in year four, you will have to add these $10,000 that you've claimed over the years as income, the year that you sell the property. So that is why I said it's similar to RSP. It's just that the event that triggered you to report these capital cost allowance that you've claimed into income is the year that you sell the property. So the year, when assuming in year four you sell the property, you add all these income back to your all these CCA claim into your income. You'll have to pay income tax on the CCA that you've claimed. So on the full $10,000. I hope that's helpful. Tomorrow, I'm going to go through whether it is worthwhile to claim capital cost allowance against your rental properties. Stay tuned. Have a great day.